Hi, folks. This is Dr. Hussain, and today we're going to talk about managerial accounting, and this is basically the introduction. So after this chapter, after going over through this chapter, you'll have a fair idea of what you could expect to learn in this course throughout this semester. So first thing, what is the role of managerial accounting? So managerial accounting, sometimes it's also called accounting for decision making. It helps managers to make important decisions. So it provides essential and necessary information to the managers so that they can make decisions. So for decision making, from time to time, managers need different type of information, and those information could be both quantitative as well as qualitative. So meaning that numeric as well as non-numeric, and managerial accounting provides those information. So as it could figure out that managerial accounting does not only provide financial information, it also provides non-financial information to manager. For example, you want to launch a new product. So what is the cost of manufacturing the new item, new product? And then when you sell it, what will be the selling price? How much revenue you're going to generate? So then you can compare the revenues with the costs and have a fair idea of whether it's worth launching the product, because if the revenues are greater than the cost, that means you have a profit. Otherwise, you don't. So managerial accounting helps in this. It's just a very simple example that I just gave you. It also, two crucial part, remember, for managerial accounting is that it helps planning and control. So planning and control, as we'll see later, that in budgeting we'll be dealing with planning. There is also another chapter called standard costing. There also we will be focusing on how managerial accounting helps in planning. And then controlling, which you could also say that managing, with the help of managerial accounting, managers can manage different products, people, project, or different segments of the business. So anyway, this is just giving you a brief idea. We are not worried about the details. As we keep on exploring different chapters, different sections of this course, it'll become clear to you how we could achieve, or managers could achieve these functions with the help of managerial accounting. Now, a very effective way to have a fair idea about managerial accounting is to compare it with financial accounting. So here, this is what we are doing here. So from user's perspective, the financial accounting, which is accounting 1 that you already took, which is the prerequisite for this course, that is prepared, remember, for external users, like who? Like creditors, investors, and also for the regulators. So they are external to the organizations, not within the organization. On the other hand, managerial accounting is purely used for internal purpose. So mainly managers, as sometimes employees might also need to use managerial accounting information. So this is, remember this thing, that here our focus is internal users. You remember that when we were preparing financial accounting reports, we were using something which we call GAAP, Generally Accepted Accounting Principles. So we had to use those principles to prepare financial accounting report. In managerial accounting, however, there is no hard and fast rule. So what standard are we going to follow? Whatever standard, whatever is most helpful to us. So we do not follow any specific standard, but we just prepared the way which is beneficial for us. Okay. So as we go through different chapters, you'll see that we are not applying anything called accounting principles, generally accepted accounting principles. So the financial statements, just to remind you real fast, that the financial statements that you prepared, if you could remember, the main financial statements were income statement, balance sheet, statement of cash flows, and retained earnings statements. So those are all prepared according to GAAP. In managerial accounting, what do we do? Some of the things that we do is performance evaluation report. We prepare cost reports. We prepare budgets. All those things that we prepare, however, important thing for you to remember is that there is no application of generally accepted accounting principles. Nature of information in financial accounting, objectivity and reliability is crucial. So whatever we have, that has to be objective, which means that has to be backed by evidence, that has to be backed by documents. For example, you record a land that must be backed by a deed. There has to be proof that you purchased this item for X amount of money. Also, as this ensures reliability, because you cannot absolutely, according to generally accepted accounting principles, you cannot report anything which is not reliable. And if you could recall, in nature, financial accounting information is historical. So whatever happened in the past, that is what we only record in financial accounting. In financial accounting, we do not worry about the present or the future. Whereas in managerial accounting, our prime focus is future, and also we look at relevant information. So sometimes, see, this information, and as we'll see, for example, just think about it using common sense. Budget is a future-oriented thing. It forces you to think about the future. So that's why everything is not, objective here. Everything cannot be verified because you don't know what's going to happen in the future, right? So there's no way you could verify this thing. You try to present a most accurate picture of the current situation or the future situation, but it cannot be purely objective. So it is to some extent subjective. And here we focus on relevant, and there's a specific chapter where you will see we talk about the relevant cost and relevant revenue. So this relevancy is really an important factor here. We'll focus a little bit on this relevant thing later in this chapter, and as I say, later on we'll get tons of opportunity to explore it in a separate chapter. Frequency. Financial accounting information are provided or prepared on a regular basis. It could be monthly, quarterly, or annually. Remember, if you could remember, there was something which is called annual report, which is called also 10K. So this annual report, companies have to prepare those and annually need to report this information, need to submit this information. And then there are also quarterly information, which is called 10Q. There could be also monthly. It's not mandatory though, but sometimes companies do them. On the other hand, there is no hard and fast rule that you prepare managerial accounting reports, on quarterly or monthly or annual basis. So whenever you need it, you just use it. Today, I want to make a decision on whether to extend my facility. I want to extend my factory. So right now, I need to make the decision. So all the relevant information that I need that have to be presented to me right now. Okay. So most important thing, remember, there is no regular frequency. Then the level of details. Financial accounting mainly focuses on the company as a whole. That means you have a large company, financial accounting reports, annual reports, quarterly reports, monthly reports, whatever you say, they basically are about the entire company. Whereas in managerial accounting, what we try to do, and again, it'll become clearer to you eventually when we go to the advanced chapters, you'll see that we chop out the organization into different parts, which is called segments, division, or departments. So these segments, for example, you have 4 geographic areas. You are working, you have operation in US, you have operation in Canada, you have operation in Europe. So these are all 3 different geographic segments. Also, segment could be in terms of product. So you have multiple product. So you have, for example, beverage. Think about Pepsi. Beverage is one type of product. Then the other type of product, for example, pizza. And then you have Pizza Hut. Then you have Taco Bell. That is another product. So you could have information on different products. So I hope you got the picture here that we provide information on segment basis. And so these different segments could be product, could be region or geographic. It could be something else. So here again, the same thing is presented. Whatever we learned, it's just the way it's been presented is a bit different. Graphically, it's different. Otherwise, everything is the same. Now, it's important for us to know the type of the organizations. Why? Because the way managerial accounting will be used differs from organization to organization. So here I'm sure you know about this, but just to recap, basically we have 3 types of business organizations: manufacturing, merchandising, and service companies. So I'm starting with the simplest one, which is the service company. Service companies, their product is their service, like a law firm, that's a service company. A CPA firm, that's a service company. All right. You could also think that, a physician's office, that's a service company. So again, they are not making any product. The next type of organization is our merchandising companies or the trading companies also. So they're basically buying and selling products. If you think about Walmart, Target, they basically buy and sell product. Even though in Target you might see some Target brands, but remember, they don't manufacture it. They buy it from a third party. So they are not manufacturing, they are simply trading or merchandising. So they are not manufacturing anything. All the thousands of products that you see inside Walmart, they are not manufacturing. They're just buying it from someone and selling it to you. So this is what is simply merchandising or trading concerns for companies. Finally, we have manufacturing concerns whose operational system is the most complicated. Here, what they do is that they manufacture products. So they buy their raw materials, and from the scratch, they manufacture the products. They finish the product and sell it. Think about it like Toyota, it's a manufacturing company, right? It starts manufacturing the car from the scratch all the way till the car is built, Toyota company sells it. So it's a manufacturing concern. Now, of course, manufacturing concern is the most complex operational structure. So manufacturing concerns costing system is most complicated also. That's why, as you will see, that in this managerial accounting course, we primarily focus on manufacturing concerns because, as I've told you, it's most complicated operation, makes it more challenging, and that's why if you know how the costing system or managerial accounting system of manufacturing concerns work, you basically have a thorough idea of application of the concepts and application of managerial accounting techniques. Now, here we're just trying to give you some idea about the role of cost in managerial accounting. So cost is really important here. And in managerial accounting, we are focusing on cost. We are focusing on cost, and then this is helping us to achieve different important administrative objectives like planning, implementing, and controlling. For example, you want to launch a new product. Now you need to know how much is the cost of the product. Why? Because if you don't know the cost, you cannot determine the selling price. Let's say the cost for 1 unit of a product is $80 and you want to add a markup of $20. So now your selling price is $100. So you know exactly how much is the cost, and then after adding your target profit, your desirable amount of profit, you determine the selling price. Also, there are other kind of costing information that you need. Inventory is a major thing for especially a manufacturing company, for merchandising company as well, but manufacturing, it is really crucial. So whenever you're storing the inventory, it requires cost because there's maintenance cost, there is security cost, there's insurance cost, all those kind of costs. So you must determine in advance how much is the cost. You need to have an idea. So you get the cost of storing the inventory. Then you're planning to launch a new product or your existing products through a new website. So you have, let's say, two options. Either you could involve your internal IT department, if your IT department has the expertise to build a website, or you could hire a third party. So you compare it, the cost of doing it in-house versus, what we call is outsourcing. So which one is cheaper? So we need to compare the cost of those two. So here also we need specific and very clear information about the cost of launching this website. So in this sort of cases, managerial accounting is really helping us. So these are just two simple examples which give you some idea of how and why and in what ways managerial accounting could help us. Now it's important here, we are going into a little bit more technicality, and we are now trying to learn some cost terminologies. Remember, this cost terminologies, we'll be using this a lot throughout this entire chapter. So you'll see that these are very interesting and not really that complex thing, but very important. I can't emphasize this important. It's very important that you have a clear understanding of these types of different costs, which we could say that different cost buckets. Okay, so let's talk about this. Here, different type of cost terminology that we'll be facing are either direct or indirect, manufacturing or non-manufacturing, product or period cost, variable or fixed cost, and relevant or irrelevant cost. So let's first talk about the direct versus indirect cost. Let's give you a very simple example here. Let's say you were taking a managerial accounting course, right? Now, the tuition that you were paying to attend this course, or the books that you were buying, right, that are specifically linked with this course, right? So these are direct costs. These are directly linked. So the bottom line is that it's easily and conveniently traced. So you know exactly to get this course, you need to spend this much tuition, you need to spend this much for the books. And if anything else, like for the homework manager, you need to buy something, that is also a direct cost. However, there are some costs which you cannot directly trace with this course. For example, gas money that you pay. Your gas money that you pay to come to the campus, it's for different purposes. And you are coming not just to attend the managerial accounting course, you are taking 4 other or 3 other different courses, right? So you cannot say that I spent, let's say, $1.50 just to attend the managerial accounting course today. No, you don't say that because you cannot directly trace, but those costs are important, right? Also, think about it. You bought a computer, right? Now, this computer you're using for all those different purposes, learning managerial accounting is just one of it. So you cannot say that I spent 20 cents or 80 cents or 40 cents worth of computer for managerial accounting, because you are using for other courses, you are using to surf webs, you are using to watch movies, all those different kind of things, right? So this is something which is not directly traceable. So the important thing here is that something which is not directly traceable, but you need these costs to run the production, we are calling those indirect costs. Now we talk about manufacturing and non-manufacturing costs. Now, as the term says, it's just as simple as that. Manufacturing costs are directly linked with manufacturing, and non-manufacturing costs are not linked with manufacturing, but we need those costs. So as we'll see soon, that non-manufacturing costs are classified into mainly 2 categories, selling and admin costs. So let's first talk about the manufacturing costs. Broadly speaking, we categorize manufacturing costs into 3 parts: direct materials, direct labor, and manufacturing overhead. So let's first talk about direct material. What is this direct material? These are the cost of the material that could be directly traced with the final product. For example, you think about handbag that you are making, leather handbag. Now, the main component whenever you look at it is the leather, definitely, right? You could touch, you could feel, you could smell the leather. So that is directly linked with the final product. Whenever you look at a car in the same way, the stainless steel that you see outside, you could touch, you could feel it, right? So that is direct material. Also, if you look at a wooden table, any wooden furniture or in a wooden chair, whatever, you could see that the wood is directly, you see this, right? So this is directly linked with manufacturing this furniture. So these are examples of direct materials. Then we have direct labor. So here we are talking about the labor cost that is directly linked with the final product. For example, you are manufacturing automobile, right? So you are manufacturing automobile, fine. There are people who are just working to manufacture the automobile, nothing else. For example, some of them are working to manufacture the windshield. Some of them are working to manufacture the carburetor, okay? Some are assembling those things. So their job, remember, your final product is the car. you could directly trace this labor with the final product. So that is why we are calling those direct labor. However, there are indirect costs, indirect manufacturing costs more specifically. We call that manufacturing overhead. So remember, manufacturing overhead is all kind of what all kinds of manufacturing costs that do not fall under the category of direct material and direct labor. We call those manufacturing overhead. These are indirect manufacturing costs. So easy way to remember is that manufacturing overhead is what? Indirect manufacturing costs. So some of the examples of those are indirect material and indirect labor. Now think about it now. Indirect material. Now you have, let's say, a wooden furniture, a wooden desk. So the wooden desk, definitely you directly see the wood, which is directly linked with it. Now, there are something which are not directly linked, but indirectly linked. For example, you need to use glues. You need to use nails. So these are something which you cannot, it's not easily traceable, right? But you need those to assemble the product. So that is an example of indirect material. There could be indirect labor as well. Like the automobile example that I gave, you need people, like cleaning people, right? Now their job is not directly linked with manufacturing the automobile, but you need to keep the factory clean, so you need their service. They're factory supervisors. The supervisors are working, right? So their job is not directly linked with manufacturing, but they're supervising this process. There could be other, so I just give you an example of indirect material and indirect labor. There could be other indirect costs. For example, think about the factory rent. Now this factory rent, the money that you are paying, see, rent is not linked with manufacturing directly, but you need to pay the money. Insurance that you are paying for the factory, right? You want to make sure that the factory is secured. God forbid, if anything happens, you could take care of that. So you need to have the insurance. So this insurance cost, you need to pay this money, but you cannot directly link it to the car itself, right? Similarly, utility expenses, like I told you, production supervisor salary. So these are, so I hope you got the idea of what is called, manufacturing overhead. This manufacturing costs is an important classification. We already talked about some manufacturing costs. What did we say? We say that manufacturing costs is three parts: direct material, direct labor, and manufacturing overhead. This is just an important terminology for two important terminology for you to know. Whenever you add direct material and direct labor, what you get is called prime costs. And whenever you add direct labor with manufacturing overhead, those are called conversion costs. So the reason why the first two, one direct material and direct labor, are called prime costs, because that's the major or the prime or the major cost, main cost. And direct labor and manufacturing overhead, these are called conversion costs. Why? Because to convert raw material into fine finished products, you need to bear these expenses. So that's the reason why we call those conversion costs. We talk about non-manufacturing costs. Now, so far, all the costs that we talk about, direct or indirect, they were manufacturing. A manufacturing company, think about it, a car manufacturing company, they of course have tons of manufacturing costs. However, they need to spend some money which are non-manufacturing. It's not directly linked with manufacturing. For example, advertising expenses, right? You want people to know about your product, so you have to spend money on advertising. Okay. Now, also think about it. Toyota Manufacturing Company has its factories. Now, it has a head office. Now, the head office is not directly linked with manufacturing, but people working there are playing the most important role. Why is that? Because these are the people who run the organization. So you have the CEO, for example. You have the accountants. You have a legal department. So anyone sues you, what's going to happen? That's why you need to keep a legal department. You have the IT department. So think about it. These people, none of these people who are doing these functions, they are directly linked with manufacturing. In fact, maybe they do not even know how to manufacture the item, but of course, their job is essential. So we are calling this admin costs. So again, non-manufacturing costs, we could classify into two parts: general and admin costs, and then marketing and or selling cost. Okay. There's another important classification which is called product and period cost. Let me tell you what's the difference between the two. Product cost, another name for product cost is inventoriable cost. It's not mentioned in the slide, but it's important for you to know because inventoriable is called. Why? Why? Because to determine the cost of the inventory, you remember, if you could remember in the balance sheet, you saw an item that was called inventory. So this inventory, to determine the cost of the inventory, what type of cost do you consider? You consider manufacturing costs, and those are also product costs. So, a couple terms here, right, and which we are familiar with already. Product costs are manufacturing costs, which means direct material, direct labor, and manufacturing overhead. Together, they are called product costs. On the other hand, non-manufacturing costs, these are like selling and admin, as we were just in the previous slide, we were talking about it. These are period costs. So now here you see, it's a nice in this diagram, they put it in a nice way. First, you purchase raw material, right? You're manufacturing the car, so you have steel and other things. Now you put it into the production. When it goes there, you're adding with this direct labor. People are working to manufacture the cars, and there are other things like utility expenses, insurance expenses, supervisors who work, all those kind of things. So whenever you put those things, it's called work in process. Again, we'll be dealing with this in a later chapter in details, but for now remember this, the raw material, when we put it into the production and we add direct labor and manufacturing overhead, that becomes work in process. As soon as the product is finished, we don't call it work in process anymore, that's finished goods. It's now ready to be sold. Now this finished goods expenses, what we're going to do is that once we have this finished goods, we sell it, and as soon as we sell it, it becomes cost of goods sold. Now you see here, the manufacturing cost that you see, they are playing all these roles here. To determine the cost of the goods sold, starting from the beginning to end, these are all playing the role. And these are all our product costs. On the other hand, period costs are for a particular period. Now, what you do is that, remember this thing, you take one particular period, let's say a year. For the entire year, what you were doing is that you are taking into consideration the total amount of utility expenses in the marketing department, the total amount of utility expenses in factory outlets, the total amount of salary that you were paying to the administrative staff. So you're taking the period here. For this particular period, you determine all the manufacturing costs. That's another reason why we call this period expenses. So I hope it's clear to you what is a product cost and a period cost. Just to recap, product cost of direct material, direct labor, and manufacturing overhead, in other words, manufacturing costs. To determine the cost of goods sold, we basically look at this product cost. Period costs are our non-manufacturing costs, and the reason why we call it period cost is that here we accumulate this cost over a particular period, So period plays a major role here to determine the period expenses or period costs. Then there comes another type of classification. Here we are calling this cost direct variable costs and fixed costs. So variable costs are the costs that are that increases in direct proportion to the changes in activity level. What do I mean by this? Let's say I'm manufacturing products, right? The more and more, let's say, desks, the more and more desks I manufacture, the more and more money I have to spend for wood, right? So that's why it's a variable cost. I don't manufacture, I don't pay for any wood. I manufacture, I pay for woods, right? So as the number of units increase, the total variable cost increase. That's why you see it's an upward sloping straight line. However, on a unit basis, remember this thing, that variable costs are fixed. So this is parallel to, if you remember, that this horizontal axis is our x-axis and the vertical axis is the y-axis. So this unit variable cost is parallel to the x-axis because this is fixed. I'll just give you a simple example. For example, the cost of manufacturing, to manufacture 1 unit of a product, you need to spend wood worth $10. So for 1 unit, you pay $10. For 2 units, you pay 20, 3 units, 30, and so on. You manufacture more and more, you pay more and more. Okay, so there's a direct link between how many units you are manufacturing. Okay, however, the unit cost is still $10. No matter how many units of manufacturing and selling, the unit cost is $10. Fixed cost, on the other hand, it doesn't matter how many units we are manufacturing and selling. Now think about it. I have a restaurant here. In the restaurant, I have to pay rent. It doesn't matter how many customers I'm serving. I still have to pay that rent. Let's say I'm paying insurance expenses, right? That is fixed. So it doesn't matter how many customers I'm serving. I have to pay that insurance expense. So this has nothing to do with the output per se. So irrespective of output, we have to pay this. So that's why you see this total fixed cost line is parallel to our x-axis. However, the unit fixed cost line is a downward sloping line. Why is that? Because on a per unit basis, as we keep on serving more and more customers, let's say, unit fixed cost decreases. For example, my total insurance expense for a month, let's say, is $100, right? If I serve only 5 customers, that's what, $20 a piece, 100 over 5. On the other hand, if I serve 100 customers, it's what, $1 a piece, 100 over 100. So as you see that as we keep on increasing the number of customer increases, unit fixed cost decreases. So remember this, the total fixed cost is not changing, but unit fixed cost is a downward sloping line. It keeps on getting lower and lower as we keep on manufacturing more and more units of product. Then there's another type of classification which is called relevant versus irrelevant. Here again, you might find these terms a little bit vague, because the truth is that it is a little bit vague, and until we look at a lot of practical examples, it wouldn't be becoming clear. But the good news is that later we have a separate chapter where we talk about this relevant and irrelevant cost. But for now, just remember that what kind of cost is relevant? Something which could affect our decision. So if it does not influence our decision, it's not relevant, right? And one major feature of relevant cost is that it differs between or across alternatives. Just give you a simple example. You want to rent a shop. Now, either you could rent the shop in Atlanta, or you could do it, let's say, in Valdosta. So in Valdosta versus Atlanta. So if you rent it in Atlanta, you have to pay rent here. If you do it in Valdosta, you have to pay rent there. So there is a difference in the rent. So that's why it's also called, by the way, differential cost. So it varies between alternatives. And then another thing is that it's future oriented. So in managerial accounting, we say here in this chapter that managerial accounting deals with future. So relevant costs are future oriented. Something which let's say we spend some money to buy a building. Now, this building is scrapped. So money that we paid for this building is irrelevant. It's called sunk cost, and sunk costs are never relevant, right? So again, just a very brief idea of relevant versus irrelevant costs. Sunk costs, as I was saying, is irrelevant. Then there is another type of classification, out-of-pocket versus opportunity cost. So what is this out-of-pocket cost? Out-of-pocket cost is which involves payment of cash. So you're paying money out of your pocket. So in financial accounting, in an easy way to remember is that in financial accounting, everything that we were dealing with were out-of-pocket costs. Okay, we had to pay money for this. There's another type of cost, which is an interesting term, and we'll see its application later. It's called opportunity cost. It's called the cost of lost opportunity or foregone benefit. Just give you a very simple example, an intuitive example. Let's say you were working in McDonald's and you were making, let's say, $15,000 a year. Now, you're coming to attend the school. When you're coming to attend the school, you have to pay tuition, room and board and everything. So those things involve cash outlay. So we are calling those room and board, tuition, blah, 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 all this kind of costs as out-of-pocket costs. However, that's not the only cost, remember, that ineffectively you are bearing. because you are coming to school, you are not making that $15,000 that you were getting by working in McDonald's. So that money that you were not making, this is the cost of the lost opportunity. So this is a foregone benefit. You forego, because of coming to school, you are foregoing this benefit. So that $15,000 is your opportunity cost, right? So again, later on in relevant, when we go over a chapter on relevant cost, we'll be looking at its application of out-of-pocket versus opportunity cost a lot. So that basically concludes our discussion on chapter 1. Sorry, there is just one more thing here to discuss. Here again, it's nothing new. This is basically a summarization, a graphical way to present. So if cost is traceable, we are calling it what? Direct cost. If it's not, then it's indirect cost. Then if it's linked with manufacturing, we are calling it manufacturing. If it's not linked with manufacturing, we are calling it non-manufacturing. Manufacturing has 3 types of cost: direct material, direct labor, and manufacturing overhead. So these costs together are product costs. And then non-manufacturing has 2 types of cost. What? General and administrative, and the selling. So general, administrative, and selling together, they are called period costs. So again, direct material, direct labor, and manufacturing overhead, those are called product costs. And general and administrative and selling expenses, those are called period costs. And then the last type of cost that we talked about just in the previous slide, variable versus fixed cost. As we change the level of units, the total cost keep on changing, we call it variable. If it does not, then we call it fixed. All right. So that's it. So we'll be looking at, from the next chapter onwards, we'll be looking at an application of these concepts a lot. Thank you very much.